Imagine a young professional in their 20s. They receive their paycheck, pay their bills, and responsibly lock the rest of their savings into a traditional fixed deposit. They feel smart, secure, and entirely on track. However, that traditional path hides a structural flaw that can lead to a steady loss of wealth over time. The problem begins with how we measure prices. The government reports a consumer price index hovering around 4 to 6%. But that index tracks cheap consumer goods, like basic groceries. It largely ignores the massive, unavoidable milestones that actually drain middle-class wealth. This chart shows the reality. While the official CPI looks manageable, the actual inflation rates for the milestones that dictate your future are much higher. Education is climbing at over 10% a year. Healthcare costs are rising at 13 to 14%. Housing and gold are consistently surging near 10%. Let's apply those real numbers to that safe fixed deposit. Say you lock in a solid 7% return. As soon as the year ends, taxes come due. If you fall into the 30% bracket, the government takes its cut, leaving you with roughly 5%. When we subtract a realistic 8% middle-class inflation rate from your net gain of 5%, the math becomes clear. You didn't grow your money. You ended the year 3% poorer. Traditional banking, combined with official government metrics, creates a silent trap. By choosing the safest possible path, you ensure your purchasing power permanently shrinks. Once inflation eats the foundation, modern consumer capitalism targets whatever capital you have left by leveraging a very human vulnerability: social insecurity. The economy thrives on peer pressure. A college friend buys a new SUV, so you feel the sudden urge to upgrade your own car. Someone in your circle hosts a lavish, multi-million rupee wedding, and suddenly your modest plans feel inadequate. You start matching their spending just to feel like you belong. This engineered social pressure pushes young earners directly toward the next trap: high-interest personal loans and maxed-out credit cards. You might hear financial influencers defend this, claiming debt is a strategic tool because American billionaires borrow against their assets. But U.S. tax law is designed to reward leveraging debt. In India, repaying personal consumer debt comes out of your highly taxed income, offering absolutely zero systemic advantage. Borrowing to fund vacations or cars locks you into a cycle of selling your future labor to an institution just to impress people today. Realizing this, many young earners turn to the stock market to try and outpace inflation, and that is exactly where the financial industry waits with a new set of traps. You will immediately face heavy marketing for active mutual funds, heavily pushed by brokers and advisors, positioned against quiet, boring index funds. This visualization compares the long-term impact of their expense ratios. A simple index fund might charge a tiny 0.18% fee. An aggressively marketed active fund might charge 0.71%. Over 20 years, that difference devours a massive slice of your total returns, regardless of whether the fund actually performs well. If you manage to dodge the high fees, the next lure is futures and options trading. Influencers prey heavily on youth unemployment, promising massive overnight returns through complex F&O bets. F&O trading functions as a statistical casino. It is precision engineered to rapidly transfer wealth from retail traders directly into the pockets of massive institutional players. High-fee active funds and speculative trading aren't designed to grow your net worth. They exist purely to fund your broker's lifestyle using your principal capital. Defending your wealth requires accepting a basic truth. There is a highly boring way to get rich and a very fast way to get poor. Warren Buffett operates on a primary rule of investing that serves as the perfect filter. We never put our money into instruments where the capital has a risk of going to absolute zero. This also means abandoning any attempt to time the market with massive lump sum investments. History shows that buying at an all-time high can trap your money in stagnant markets for decades. Instead of gambling on volatile returns, your first true line of defense is aggressively scaling your active income. The most effective way to multiply your capital base often comes from changing your job address. Relocating to high-paying international hubs can radically increase your baseline earning power. Aggressive income generation in your 20s is the only reliable way to build a shovel leg enough to outdig the real rate of inflation. The second defense mechanism is ruthlessly isolating yourself from peer pressure spending. Even as your income scales, maintaining a low-cost lifestyle ensures that new money actually stays in your accounts. Once you have that growing pool of capital, you take the exact amount you absolutely will not need for the next 10 years and deploy it quietly into low-cost index funds, like the Nifty 50. You set up consistent, automated investments, and then you ignore the daily market volatility and the endless panic of the financial news cycle. Dodging these systemic extractors and ignoring flashy trends in your 20s prepares your 30s for financial stability rather than panic.